Good afternoon, everybody. Good morning to those that are not on the East Coast like me, but good afternoon to those on the East Coast, and good morning to everybody else here observing this webinar today. I am going to be your host, Stuart Otto, and I am a Medicaid planner with Ashburn. So our topic today is going to be on, one second here. Our topic today is going to be on Medicaid compliant annuities and promissory notes in Medicaid spend down situations. Now, I'm going to specifically kind of tailor this presentation towards the economic analysis of using an annuity versus using a note, because as a lot of us probably already know, and I'm going to talk about it briefly in the first part of this presentation, is that notes and annuities can kind of be used interchangeably and really accomplish sort of the same thing. So we really have to look at other avenues and other areas of the products that will affect a client's decision on whether or not to use a promissory note or whether to use an annuity. So we're going to focus on the economic impacts of using one or the other. And then we're going to, after that, talk about some non-economic impacts that will affect whether or not you use an annuity or a note. But for the first maybe 10 or 15 minutes, I'm going to give some background here on Ashburn, on what crisis planning is, what a Medicaid annuity is, and promissory note. So once we get through that, then we're going to go into the more meat and the potatoes of this presentation, which is going to be the economic analysis and the cost analysis of using these annuities and notes in your planning. But first, wanted to go ahead and introduce you to myself a little bit. My name is Stuart Otto, and I am a Medicaid planner and annuity specialist with Ashburn. I have been with Ashburn going on about a year now, but I've been in the industry for about 10 years. So if you choose to work with me on your Medicaid compliant annuities, you're getting someone who's been in the industry for a long time and someone who handles your cases and situations very carefully and will work as hard as he can to get you everything that you need for your clients. In addition to that, I am also a licensed life and health insurance agent in about 30 states. My main resident license is in Florida, but I do have also non-resident licenses in other states as well. And then a couple nice interesting facts about me is I was a former member of the Wisconsin Army National Guard for a period of 6 years. And I am also the proud dog dad of a near 3-year-old Australian Shepherd named Grover. He's a cute little red merle, like 40 pounds and so, and he's basically my head of security here at my home office. So he's always very, very attentive to when anybody's coming into the home office. So he always lets me know if somebody's there. So it's very nice to have him around. So I'm going to go ahead and get into the presentation here, and I'm going to take myself off of the monitor. So give me 1 second here. All right, so Ashburn as a company, we are an annuity company, a financial services company that specializes in crisis Medicaid planning and Medicaid compliant annuities. So we provide complementary planning assistance and spend down support. So we are not just the annuity provider, we also provide the support needed to calculate the spend down and then execute the spend down as well. So we can assist with things like IRA rollovers, 1035 exchanges, or just filling out the Medicaid or MCA application as well too. All the carriers we have are A-rated insurance carriers for the Medicaid compliant annuity, even the annuity that has a very short term. So they're all A-rated with either American AM Best or with Demotech. And then also Ashburn as a whole, we do have over 15 years of experience in the industry. Ashburn has been in existence for just over 5. We celebrated our 5-year anniversary on April 1st, so that is very exciting news. And things couldn't be better here. So, between myself, Amber, and then Jessica also, who does a great job with our administrative work, we have multiple years of experience in this industry and do a great job with handling your annuity needs. All right, so a little bit about our products. We have We have a line of annuities, basically Medicaid compliant annuities, and then we also have tax deferred annuities as well. We may do a tax deferred annuity in a pre-planning situation, or if you're in Texas, we do those with IRAs, sometimes for Medicaid spend downs. In addition to that, we also have irrevocable funeral trusts and single premium whole life policies in select states to help spend down for Medicaid as well too. And then we also are in the pre-planning market. We do sell a lot of asset-based long-term care insurance as well. So if that's something you're interested in, please feel free to contact myself or Amber, and we can talk to you about that a little bit more. In addition to that, our services, which we went over a little bit, first we provide complimentary planning analysis and Medicaid compliant annuity quotes. Again, that's free of charge. That's part of the built-in service that we provide. Spend down support, again, Medicaid compliant annuity applications, IRA rollovers, or any other trouble you might have with liquidating or spending down an asset, we can be there to help provide you the support in that process. And then lastly, after the policy is issued, we provide support with a death claim if the annuitant passes away. We also provide fair hearing support and testimony if your client is ever adversely affected by one of our annuity purchases. All right, so we have one slide here dedicated to crisis planning. Basically, crisis planning is a situation where an individual is in immediate need of financial relief from long-term care services, typically nursing home level services, but we do see assisted living cases as well too from time to time. In addition to that, we have various planning strategies used to help spend down some of those assets and protect some of those assets while accelerating the Medicaid eligibility process. So today, we're going to talk, as I mentioned, about two of those particular spend down tools that help preserve some of those assets. That is the Medicaid compliant annuity and the Medicaid compliant promissory note. So the first one we're going to talk about and get into is the Medicaid compliant annuity. And we're just going to provide some information here that is impactful, but we're not going to really dissect it here. So the basics of the MCA, because we can always probably have another presentation and talk all about the details of a Medicaid compliant annuity and a Medicaid compliant note. So I'm just going to give you the broad scopes with both of these tools. So the Medicaid compliant annuity is what we call a single premium immediate annuity, or as us in the financial world call it, a SPIA. Basically, it's a conversion of a deferred annuity or a lump sum cash payment into an income stream. So a lot of time, I should say all the time, these annuities, Medicaid annuities, are purchased with a large, substantial single premium amount, which can come from a bank account, an IRA, or it can come from an existing annuity like a deferred annuity. And one rule of thumb that I always have here, and I would probably always put this on my presentations whenever I'm talking about annuities, when you're dealing with an annuity that you have in your office, you want to keep in mind that all Medicaid compliant annuities are immediate annuities, but not all immediate annuities are Medicaid compliant. And that's a slogan I've been saying for years. I've kind of adopted that from the whole geometry class, where a square is a rectangle, but a rectangle is not always a square. So that is an important thing to know when you're dealing with existing annuities with clients. Again, that's probably a topic for another day, but something that I think is very important to illustrate when we're talking about Medicaid annuities and SPIAs. So in addition to that, the Medicaid annuity provides periodic payments, typically monthly, to either increase income for the community spouse or to pay through the penalty period of an intentional gift. In addition to that, payments by the annuity are made by the insurance carrier, and the annuity, the Medicaid annuity, is compliant with the rules of the Deficit Reduction Act, which we refer to commonly as DRA. And right here are the DRA requirements. So the annuity, first and foremost, needs to be irrevocable, non-assignable. Essentially, you can't revoke any provisions of the contract, you can't have any cash value associated with it, and you can't change the ownership or assign the ownership to somebody else. You can't sell it on the secondary market to J.G. Wentworth or Peachtree or another third party that's buying income streams for 50 cents on the dollar. You can't do that. It has to be irrevocable and non-assignable. Additionally, the annuity has to be actuarially sound. Unfortunately, this is not language that's typically put into the annuity contract, basically you can't just check off a box and say, I like to make this annuity actuarially sound. You have to structure the payout that is sufficient within the client's needs. So specifically, that means it has to provide a payout within the Medicaid life expectancy. So depending on your state, you want to check the appropriate tables to determine that life expectancy. And then also keep in mind that this does mean that there should be no life or no life with period certain options with a Medicaid compliant annuity, because that will imply a longer term than what their life expectancy is. So when you're looking for a Medicaid compliant annuity or looking at an annuity, you want period certain only payouts. And then additionally, to make it actuarially sound, it needs to provide a positive rate of return. So this is provided by the insurance company and paid for by the insurance company during the payout period of the annuity. The annuity must also have equal payments with no deferral or balloon payments, no inflation riders to increase the payments, and then you have to list the state as beneficiary in the appropriate position for the amount of medical assistance provided to the Medicaid applicant. And then lastly, the parties to an annuity contract, this is kind of general to all annuities, but particularly the Medicaid annuity, the owner, the annuitant, and the payee are often the same person in a Medicaid annuity. So it really kind of simplifies the parties a little bit. But the owner is the purchaser of the annuity contract and basically negotiates the terms of it at the point of sale. Once the sale's made and it's irrevocable, then the owner can't really revoke anything at that point. The annuitant is basically the insured on an annuity contract. So you have insureds on a life insurance policy. The annuitant acts as the insured on an annuity policy. So that is the individual that they measure the life of the contract on. So as long as the annuitant is still living, no death benefit is going to be triggered. But if the annuitant passes away, that's when the death benefit gets triggered and the beneficiaries come into play. The payee is going to be the recipient of the income payments, and the beneficiaries are going to be the individuals or entities entitled to the death benefit if and when the annuitant passes. I know a lot of people get payee and beneficiary mixed up, but the beneficiary is specifically the individuals entitled to the death benefit, and the payee is the one that's receiving the benefits of the policy. And then lastly, the insurance company, as I mentioned, is the obligated party that is required to carry out the fiduciary responsibilities of the annuity contract. All right, so getting into the Medicaid compliant promissory note, we talked about the annuity and crisis planning. Now we'll talk about the note here briefly before we get into the cost analysis of this presentation. So here are the promissory note regulations straight out of the Deficit Reduction Act. The requirements are that the promissory note needs to be actuarially sound based on the SSA tables. It must also provide equal payments during the term of the loan with no deferral or balloon payments. Doesn't that sound familiar? And then the third, the promissory note must prohibit cancellation upon the death of the lender, basically. So that's a roundabout way for the state to ensure that the promissory note has a payback provision, essentially, because you can't really put a payback provision on with the promissory note. So instead, they have you continue the payments to the client's estate, to the decedent's estate, and then that's where they use estate recovery to collect for benefits paid. And then in addition to that, the note must also pass what I call the asset test. It must be irrevocable or bona fide, and it cannot have the ability to be sold. So we want irrevocable and non-assignable notes as well. And then to make a promissory note actuarially sound, we need to apply the applicable federal rate, which is what I am referring to as the AFR. So again, to make sure we have an actuarially sound annuity, we need that AFR, the current AFR applied. And we're going to get into that as when we talk about the cost analysis, because that's a big factor in our analysis. So one of the things I want to point out here to this point is that you can see the requirements of the note are very similar to that of the Medicaid annuity. So in order to be a compliant promissory note, you have to basically have the same requirements or somewhere around there as the annuity. So it might be structured a little bit differently, the process might be a little bit different, but really in the end, they are very similar in nature from a Medicaid perspective. All right, so the applicable federal rate, the AFR, that's a monthly. Each month, the IRS is going to provide these rates strictly for federal income tax purposes, but this is the rate again that's used to establish an actuarial sound promissory note. So as an example, April's AFR is 4.78%, and we're using the short term for any which is basically 2 to 35 months, to my understanding. So and we typically don't use 36 months or more for the mid or long-term rates, because generally speaking, if you're doing a 36-month spend down for an individual, the annuity, and we're going to get into this, I'm going to show you how through this cost analysis, 36 months is going to favor the annuity from a cost perspective for sure. So, currently the rate is 4.78%, and I believe I just checked May's, I think it's 4.86%. So it did go up a little bit. So quickly, the mechanics of the note, the payee is either going to be the Medicaid applicant or the community spouse, depending on the case. And then the payor of the note is going to be typically a reliable family member who are required to carry out the obligation. So essentially, they are assuming the role that the insurance company otherwise assumes with an annuity. So the payor must make timely monthly payments. They should document everything to avoid confusion with the state, and then also pay interest on the note to ensure compliance. So that AFR that we talked about, the payor is responsible for coming up with that additional interest each month to ensure compliance with the Medicaid rules. All right, so how are annuities and notes used? There are really two different ways that they're used, and I know we've probably already talked about these a lot in other presentations here, but the first and most common spend down is using a half loaf, which is a gift and annuity plan essentially for a single individual. We're making an intentional gift to set up a penalty, and then we're purchasing an MCA or a note to pay the income to the nursing home through the penalty period. It is also structured a certain way to where the note or the annuity and the penalty period line up sequentially, so that when they both start and end at the same time. And then the second form of spend down is a community spouse spend down, where the excess spend down, or I should say the spend down, it shouldn't say excess there, but just spend down in general is used to set up the MCA or the note to pay back the community spouse. So whatever we've set aside for the CSRA and other spend downs, then the note or the annuity is set up to immediately qualify the Medicaid applicant for benefits. And then we structure the term in a way so that hopefully the note and the annuity pays back in full before the community spouse passes. So again, and I'm going to say this say this again here basically, but the note and the MCA can be used interchangeably to accomplish the same thing. So they have essentially the Medicaid, similar Medicaid rules structured differently, and then they have the ability to be used in both spend down situations interchangeably. So how do we evaluate and how do we look at the differences between the two when deciding which one to use? And so that's what the remainder of this presentation is going to be about. So we got through the basics, the annuity explanation, the note explanation. Now we're going to get into the meat and potatoes here, which is the cost analysis of the annuity and the note. So in order to develop this cost analysis, have to identify what costs are associated with an MCA and with a note. So the MCA just has a one-time upfront fee due at the time of the annuity application. And typically when we're doing the spend down, we are deducting it from the spend down amount. So it's typically not coming from the children, it's typically coming from the assets that are owned by the Medicaid applicant and or the community spouse. The note, the cost of the note is very different. as we kind of mentioned, the cost of the note is the interest earned on the note paid by the payor over the life of the contract. So we talked about that AFR. We apply that to the purchase price of the note essentially. So there's going to be mostly principal that's paid back, but there's going to be also a substantial portion of interest that's going to be paid on a monthly basis to make sure that that is compliant with Medicaid. And in addition to that, there may be some legal fees associated with drafting the Medicaid compliant note documents. I don't know if that's more common or less common to say that that could be a potential additional cost of using the promissory note. So in order to provide an accurate analysis here, we need to understand the three variables that impact the price point of the annuity and the note. So the three are the term, the premium, and the AFR. So the applicable federal rate, term, and the premium are the three that are going to impact the cost of the note or the cost of the annuity. So what we're going to do in this analysis is I'm going to go through three different examples, and each example is going to have three different illustrations here. I'll get into all that, but we're going to essentially isolate each of those three variables in each example. So we're going to evaluate example 1 based on the term, example 2 based on the premium, and example 3 based on the AFR. So when we're evaluating the term, we're going to need to hold two of those other two variables, the premium and the AFR, constant to show you, to illustrate the cost. And it'll make more sense as we get into the illustrations here, which we're about to. So for this first example, evaluating the term. So let's say we've got a situation where the client has $100,000 to spend down. Let's call it a community spouse situation. We've got $100,000 to put into an annuity or note, and we want to look at it from a few different angles. So we're going to present three illustrations in this example. Illustration 1 is going to be a 6-month payout. The illustration 2 is going to be a 12-month payout, and the third illustration is going to be 24 months. So we're going to evaluate the cost of the note and the annuity at each term. And then we're going to, as I mentioned, we're going to assume the premium of $100,000 for the community spouse to spend down. And then we're also going to assume April's applicable federal rate of 4.78% has to be applied to make the note compliant. So let's go into the first illustration here. This is a 6-month term. So looking at a spend down of $100,000 based on 6 months, that might come off as maybe a little bit aggressive depending on what state you're in. Some states probably do this, I shouldn't say probably, some states will be more commonly using a spend down like this. Other states would go maybe 12 months or 24 months, but I wanted to provide the whole scope here because we are doing a national presentation here. So the first illustration at 6 months and the premium of $100,000. If you look at the top here, the promissory note is the top illustration, and then the MCA is the bottom illustration. And then we have the client cost here on the far right. So the client cost of the note, as you see on the top here, is just under $1,400. And how I got that was basically taking the total payout less the premium. So this minus that equals the client cost here. So that is the interest earned on the promissory note that the payor is paying over that 6-month period. Whereas the MCA in this situation, if we did an MCA for 6 months, $100,000 premium, the client cost would be $1,750. So as we can see from the bottom here, we can see from this first illustration that the promissory note is going to be the more favorable tool in this scenario, at least economically, because the client cost is about $350 less than the annuity cost here. So 6 months, $100,000. If I'm only advising from an economic standpoint, I'd advise the promissory note, unless there's a legal fee associated with drafting the documents, which in that case might bump the cost of the promissory note, or which would bump the cost of the promissory note up to a certain point, which may make the annuity more advantageous. All right, so let's take a look at illustration number 2. This is going to be a the same $100,000 that we need to spend down, but we're going to look at it from a 12-month annuity or 12-month term, excuse me. So this would probably be a little bit more common of a spend down. You could see this spend down probably either in a gifting plan case or community spouse case, either or. But either way, we stretch this from 6 months to 12 months, and we look over here, we can see how much the client cost has changed on the promissory note. For a 12-month $100,000 promissory note, the total interest earned, aka the client cost, is just over $2,600, whereas the cost of the Medicaid compliant annuity has stayed the same at $1,750. So you can see 6 months and 12 months, the client cost of the annuity has stayed the same. So in this situation, at a 12-month term, $100,000 investment, we're looking at the annuity as being the more appropriate vehicle in this situation, and it's not even really that close. It's an $850 difference. So let's take a look at one more illustration here based on a 24-month term. We can see here from the client cost on the far right how much more the client is paying in interest over the 2-year period. So $5,000 for the interest in this situation for a 24-month $100,000 note, the cost of the annuity actually goes down to $1,550. So this case, it would be a no-brainer from an economic perspective to do the Medicaid compliant annuity, because the client cost of $5,000 on the note is $3,500 more than what the client would pay with a Medicaid compliant annuity. So here's a summary of the first example here. As you can see, at 6 months, the note tends to be more favorable with a $100,000 investment amount. The 12-month and the 24-month, though, seem to favor the Medicaid compliant annuity quite convincingly, in my opinion. So in this current climate, you've got a $100,000 spend down. If you're thinking anything longer than 6 months, you are going to want to strongly consider the Medicaid compliant annuity. And so here's another way to illustrate it here. The red line or orange line, if you want to get picky about what the color is, red or orange or amber, whatever the color may be, the cost of the note just rises pretty significantly from the 6-month period all the way to the 24-month. I did add an 18-month period in here as well too. So you can see the difference, the increasing gap of the cost of each tool here. So needless to say, the annuity in most situations, you get past that 6-month point, is going to be the more economically favorable tool. And then also right here, I get into this a little bit on the next slide, this little point here, cross point, we call break even point, is at about a 7 or 8 month term. So if you're doing anything along, if you have a $100,000 investment amount and you're thinking anything longer than 7 months, you're probably going to have a better economic result using the annuity. So looking at the observations here on the first example, holding the premium constant and increasing the term is going to increase the cost of the promissory note. While the annuity goes down at 24 months, the rising term, or the longer the term essentially, the more favorable the annuity becomes. And then, as I mentioned, our break-even point in this example is between 7 and 8 months. So if you got a $100,000 investment amount under this climate, anything longer than 6 months, I think an annuity is probably going to be the appropriate economical device to use for your client. All right, so let's take a look at example number 2. So we're gonna, in this situation, evaluate the premium. So last time we held the premium constant at $100,000. Instead, we're going to run illustrations at $50,000, $100,000, and $150,000. Additionally, we're going to keep a similar term of 12 months, and then we're going to keep the April AFR again at 4.78%. So let's go ahead and look at the next 3 illustrations here. With a term of 12 months and a premium $50,000, you can see the promissory note has a interest earned or cost of $1,300. whereas the annuity has a cost of $1,500 in this case. So this one kind of becomes a little bit of a pick and choose. I mean, $200 is a close call to make. If you have preferences on annuity, if a client has a preference on annuity, if there's a few other factors here that are pushing you towards that, then maybe this is a call where you say 12 months, $50,000, I'm going to use an annuity. But again, economically speaking, a couple $100 in favor of the note in this situation. Again, that's not assuming any legal fees are being charged in this situation. If there's a legal fee being charged, we'd have to add that to the client cost of the note again. So that 12 months, $50,000, I'm not sure we see a lot of cases like that per se, but that would be a situation where it's, you know, pick or choose, you know, your option at this point. Illustration 5, which you'll notice is probably the same illustration as number 2 here, a 12-month, $100,000 annuity or note. We see the client cost over here. Again, the promissory note cost goes up to $2,608, and the annuity cost goes up to $1,750. So you do see in this example versus the first one, you do see the cost of the annuity going up. And that's because our fee structure is done in such a way to where the larger the premium, the more we typically charge, because that's a percentage of the premium versus the flat rate of $1,500. So the client cost did, or the note cost did go up to $2,608, leaving the annuity as the more advantageous product in this scenario from an economic perspective. And again, that's about an $850 difference, so pretty significant. And then looking at the last illustration here, 12 months, and we're doing $150,000. So this scenario, we see the cost of both the note and the annuity go up, but we see the cost of the note go up at a greater rate. So the cost of the note goes up to $3,912, and then the cost of the annuity goes up to $2,625. So in this scenario, you would probably, a community spouse spend down in this scenario, you would be using the MCA from an economic perspective again, because you're saving the client roughly $1,300 on this particular transaction. So here's the summary for a premium evaluation here. Again, the first one, $50,000, tends to favor the note at a 12-month rate, but the $100,000, $150,000 investments tend to favor the annuity pretty significantly. So looking at that again graphically, you notice a very similar graph to the first one with the same trajectory of the note in this one, but you see a little bit higher trajectory in the annuity because again, the cost of the fees going up. And we did do a $200,000 investment amount, but I think when you start doing 12 months, $200,000, that's tipping on the edge of, you know, whether or not that annuity would be appropriate, depending on the state, basically. So if we're going 250,000, 300,000, we might be increasing the term, which then will further create an advantage to the annuity, because you're not only increasing the term, you're increasing the premium as well. So as I just mentioned, when you increase the observation in this example too, when you increase the premium, the cost of the note rises. So again, it's kind of a similar trajectory to the term. When you increase the term, you're going to increase the interest earned on the note, and you're going to do the same thing when you increase the premium. So larger premiums, higher terms tend to favor the annuity because the interest on the note that's accumulated is going to be higher. And then we have a couple break-even points to discuss. The break-even point for the premium on a 12-month annuity is around $57,000. So it doesn't take much more than the 50 in this scenario to get above, to get to a break-even point where the annuity becomes more cost-effective. And then lastly, with the $50,000 premium, the term of the term, if we did a term of 13 months or more, then that would be the break-even point where the annuity potentially becomes more advantageous. So really, anytime you exceed 12 months or exceed maybe $60,000, the annuity is tending to become the more appropriate vehicle in these scenarios. All right, so slide example 3, and then just as you know, or just for your FYI here, when we get to the end here, we're going to encapsulate this all and give you sort of a broad generalization of everything that's done in these calculations here. So, and I will say this before I get into example 3. Examples 1 and 2 are more real time, like in the now of they're affecting, these costs are affected in the now basically. So we're using the current climate, the current interest rate. So we know those are real numbers at real time basically. So it's something, those examples 1 and 2 are more of a short-term analysis of the market as it is today. Example 3 is going to be more of a broader long-term example, because the change in the applicable federal rate is not always, is something that's going to be impactful, in the long run, basically. So I wanted to show you an illustration based off of when rates are really low versus when rates are really high. So you can have an understanding as to how that AFR is affecting costs for your client. So illustration number 7, the AFR, if we're keeping so say we need an annuity or a note that's $100,000 for 12 months, and then we're going to evaluate it at an AFR of 1%, 4%, and 7%. The 1% AFR in a low rate market really suppresses the cost of the promissory note, so that the promissory note easily becomes the more affordable solution in a 1% market. And it's pretty significant here. It's probably 1,200. So even if you extended this to 24 months or you extended the premium, I only think that'll increase the cost to about 1,000. So that will still, and then depending on increasing the premium or term, you affect the price of the annuity as well too. But low rate markets definitely seem to favor the promissory note. And then illustration number 8 here, looking at it at 4%, we have more of a split decision, if you will. The annuities favored in this one by about $430. I think it's exactly $430, based on the client cost of the note versus the cost of the annuity. This is one where maybe you could go either way on this one, but at a 4% market, this typical annuity that gets sold, or this typical case, 12 months, $100,000, tends to favor the annuity, at least economically. And then the last illustration here is when the rates are 7%, so very high. This is a situation, again, where the annuity is going to be the more favorable option, because you've got a client cost here of $3,800 and then an annuity cost of $1,750. So over $2,000 of benefit by using an annuity in this particular instance. So going through the summary on this one, again, we see 1%, the note is easily favored, but 4 and 7% tend to favor the annuity. So I think you have sort of, I didn't do a formal calculation here on the break-even point, but I think around 3.5% might be a near break-even point for an AFR at this point. So basically based on that, and I think we saw that in the presentation, that the lower the AFR, the more advantageous the promissory note becomes. But again, as the AFR increases, then the cost of the note rises. So the annuity becomes more beneficial in a higher rate market, which is currently what our AFR is. It's in a higher rate than it typically is right now. All right, so this is the encapsulated final economic observations here. And I stress that this is under the current climate, because the AFR is a monthly figure and is changed monthly. This is sort of a moving target. So I think it's always good to run illustrations both ways, just to see how the rate is impacting your client's cost of the promissory note. So generally speaking, under the current climate, I can see when you have a term, when you have a need for a term that's less than 6 months and or less than $50,000, the note becomes more favorable, because there's just not much interest that's compounded on those cases. but the MCAs definitely become more favorable when we're looking at a term of 12 months or more, or a premium of $100,000 or more. And then I'll illustrate this as a gray area here, and I kind of took a little liberty here because I honestly think if you go to even to like 9 months or more, I think the MCAs are going to kind of be more favorable in those scenarios. But anything between 6 and 12 months, or premium between $50,000 and $100,000, is going to trend towards just confirming which one's better. And most of the time, I think the annuity is going to come out because our break-even points again were between 7 and 8 months, and I think between $57,000 and $58,000. So when you look at that, the annuity is generally going to be more favorable in that gray area, basically. And then again, combined with the fact that we're using a rate of 4.78%. In May, that rate's going to be 4.86%. So that shifts even more towards the annuity, because as we learned, the higher the rate, the more favorable the annuity becomes. So 4.78 to 4.86 should lend more credence to using the annuity, or certainly considering it when you're in a gray area. But if you're doing anything a year or more, or if you've got a larger spend down, the annuity is probably more often than not the more appropriate solution economically. And then this is a real basic slide here, but a good one to note, just that annuities are more favorable with larger premiums, longer terms, and higher AFRs, whereas the note, conversely, smaller premiums, shorter terms, and lower AFRs. And always, when you're in doubt, you can ask us for a quote. We're more than happy to run promissory note quotes for you, as well as the annuity quotes that we already do run for all of our clients. So we're more than happy to do that. We monitor the AFR regularly. We do some promissory note consulting for some of our clients when the annuity is not an option. But so we do have some experience in that area as well. All right, so we're going to wrap up here with a couple slides about additional ways or reasons to use a note, and then also additional reasons to use an annuity. So number one for using a note is transferring an illiquid asset like property, primary residence, maybe a second home somewhere, something like that you are spending down maybe as part of a gift, and you don't have enough liquidity to purchase an annuity, to fund the plan properly. So you just generate a note and have the client honor that note during the payout. And then keeping funds interfamily. Some families, I think, maybe just be uncomfortable moving funds to an insurance company they may not have heard of before. And then there may be a situation where an MCA might not be available in your state. In that case, explore the promissory note. There may be another option for you out there if the promissory note's not available. So there's always different avenues to examine. But yeah, if there's no annuity in your state, obviously be hard, or no short-term annuity in your state, might be hard to choose the annuity if it's not there. So in addition to that, the annuity tends to be a quicker transaction, or the note tends to be a quicker transaction. But I will say, in our defense, I think we have done a great job of accelerating the MCA application process. If you talk to anybody that we've worked with before, or if you have worked with us before, I'm sure you'll experience that or have experienced that. We're very light on the paperwork, and have a lot of options to basically streamline that process. And then here's an important one too. There are some states out there that may only count the interest portion of the note as income when it's getting paid back. So if you're in one of those states, then you may be looking at the note as a more economically sound option, particularly for a community spouse case that has little income. So I think in that situation, if the principal portion of the note is not countable as income, and you've got low income for the community spouse, you could take advantage of the minimum rules while the note is in place. Whereas with the annuity in that situation, typically it's universal that the annuity payment is 100% countable income. So that's only a handful of states, from my understanding. That may not be
the vast majority of states that allow promissory notes, but that is a thing out there in certain states where you can do something like that. And then on top of that, reasons you may want to consider using an annuity. So obviously, first of all, if you have tax qualified funds, you would not be able to use a promissory note for that. You would have to use an annuity by way of an IRA rollover or IRA transfer, or if you have a deferred non-qualified annuity, we can do a 1035 exchange of that into a Medicaid compliant annuity. Another reason is that the anticipated payor is not trustworthy or maybe has poor credit. So one thing that is of note and I think is important is that the insurance carrier in a Medicaid compliant annuity is the one that's obligated to make the payments each month, and they are essentially they're a fiduciary, and they're essentially accredited by the state that they practice in, and then all the other states that they're also licensed in as well too. So they're obligated to make those payments. So there's a lot more security with that, especially if we've got an uncertain payor or someone like, we're a little sketchy about whether or not they're gonna, do us a favor here. And then also in that same breath, basically, the funds of the annuity are protected from potential divorce, litigation, and bankruptcy, whereas a note, you might have an issue with that. And then here's another important one. I think people often overlook this with annuities. Annuities are covered under each state's life and guarantee association. So regardless of what state you're in, the annuity has a form of a public guarantee on the product itself, kind of like FDIC for banks. There's annuity coverage for that as well in the event a insurance carrier becomes insolvent. So there are limits on that, but generally speaking, all the states will have a limit that exceeds certainly the average. I think a common limit might be $300,000 to $500,000 depending on the state. So most clients are well within that that limit. And then lastly, another reason to use an annuity is, conversely, from the last slide, there may be states out there, and I know there's states out there that don't permit the use of promissory notes. Annuities are more generally accepted by the Medicaid offices on a national level, so they're a little bit more stable than a promissory note. Promissory notes have had some poor case decisions that have affected whether or not they can be used going forward, and some states just might scrutinize them harder too. I mean, that's another thing to consider when you're filing Medicaid applications. Which one do they scrutinize harder? Do they scrutinize the annuity or the note, or are they equally tough or easy on both? So I think that has an impact as to how you want to proceed as well, especially when you're kind of in that gray zone of, the economic cost is roughly the same, so that might have an impact as to which one you choose. So just to summarize here, as I mentioned, the cost of the promissory notes rise when you have a higher interest rate market, basically. So in a situation like this right now, where it's 4.78 and then 4.86, the cost of the economic sense is to explore the annuity, certainly for anything 6 months or more, or anything that's $50,000 or more. I would definitely consider exploring that, and especially even lower those requirements if you are charging a fee to your client to draft the paperwork as well. So in addition to that, there are non-economic factors that we just talked about to consider when deciding on a Medicaid compliant annuity or a promissory note. And then the last thing I'll say is that you are always more than welcome to contact Ashburn anytime you need a quote, not only for a Medicaid annuity, but also if you want us to demonstrate a quote for a promissory note as well too. So with that, I'm going to turn it over to any questions that may have come up during the presentation. If you do have questions right now, you can always submit them as well too. So let's go ahead and take a look at those here. All right. All right, give me one moment here. All right. So I do have one question here of how how do you determine the interest rate earned on the note? All right, so the first thing that I did here, and I'm going to take you back a slide. I'll take you back a few slides. So determining the interest rate on the note is simply done by taking first of all, by taking the number of payouts, which is 12, and then multiplying it by the monthly payout here, and we get a total payout of 103,832.16. And then we're subtracting that total payout from the premium amount to get our interest earned, because the amount that's paid into the note or the amount that's paid into the annuity, that is the principal balance. And the difference here is the interest earned. So this is how I got to the client cost, because the interest earned is equal to the client cost on this presentation. All right, and then someone asked too, isn't there an interest on the annuity as well too? And yeah, I'm actually gonna stay right here then and show you, yes, there is absolutely an interest earned on the annuity. And in fact, that is actually paid for by the insurance company. That's another part of the annuity that's a little bit more advantageous. I don't typically mention that or put that in a cost analysis, because that's more of a smaller incentive, but it is something worth considering. So if you look at this case example here, 12 months, $100,000, and then we look at the difference, the annuity does provide an interest of $216. So if you wanted to apply that to the economic analysis and illustrate that the client, that there's an additional benefit here of using the annuity with the interest rate, is certainly more than welcome to do that. Certain companies though, interest rates can sort of fluctuate and become more problematic. They can go higher, lower pretty quickly on us. Generally speaking, our primary carrier, American Century, keeps the rates pretty consistent, but you never know with the industry as it is, those rates can always change. So I'd never really kind of bring that up as far as like an annuity goes, because usually they're like less than 1%. So they do have a little bit of an impact. In this case, $200, but not a overwhelming impact like we see with the rising AFR interest rates. All right. And then I did have another question about our processing fees. So just to quickly articulate our processing fees, we have a base rate of $1,500 on anything that's less than 48 months. And then if the premium is large enough, depending on the term, we may charge a percentage of the premium in lieu of the base rate. So if the percentage charge of the premium is higher than the base rate of $1,500, then we'll charge the higher of that fee basically. But we do, our annuities are offered for as low as $1,500. And I think there was a couple slides or illustrations there where we did have that base $1,500 fee. So that's about as low as we go. And then I did get one more question here. That said, how did you establish the break-even points? And that was really just kind of guess and check basically. So that was more, so you know, as I kind of got closer to like a level cost, like a even cost between the note and the annuity, it became kind of a guess and check game here. So when I went to, you know, maybe 8 months, I saw that it was maybe a little bit favored towards the note of the annuity, and then went back. So just a little bit of a guess and check there to see what was to find that. So no mad scientist formula on that. That was just kind of guess and check to get to the right to the right spot there. So all right, I don't see any other questions here at this time. So I want to say thank you very much for attending the latest edition of our Ashburn Series webinar, again on Medicaid compliant annuities and promissory notes. I'm Stuart Otto, I'm one of the planners, and if you ever have a case or if you ever have any questions, please feel free to call me at this number below, 706-717 3083. You can also email me, Stuart@ashburr.com. You can also reach out to Amber@ashburr.com. And then we do also have a toll-free 888 number as well too that I don't have on here. And let's see if I have that really quick. Let's see. Yes, 888-441-1595. I use my direct number a lot more than the primary office number, so I apologize for that. But that's our number if you do want to give our direct or primary office a call. And again, thank you very much for your time, and I look forward to seeing you next month when date to be determined and topic to be determined at this point, but we will stay in communication on that as we go along. So I want to thank you very much for your time and have a wonderful day.